In this video, we will explore the concept of probability and its connection to the stock market. By understanding probability, we can increase our chances of success when trading stocks. In many situations, it's impossible to predict events with absolute certainty. However, we can use mathematical principles and the notion of chance to assess the likelihood of different outcomes. But before we proceed, make sure to hit that subscribe button and enable the notification bell, ensuring you never miss a valuable piece of knowledge. When it comes to trading stocks, probability plays a crucial role. Rather than relying solely on guesswork or emotions, analyzing historical data, market trends, and other relevant factors is essential to estimate the probability of a trade success. For instance, let's consider the probability of being dealt a specific royal flush while playing poker. The chances of obtaining this particular hand are meager, with odds of more than 2.5 million hands. In perspective, you're more likely to be struck by lightning than dealt that particular hand. On the other hand, we have a more familiar example, like flipping a coin. In this case, there is a 50% chance of the coin landing on either side, giving us a 1 in 2 probability for each outcome. However, it's essential to distinguish between these events and the stock market when predicting future prices. While we can calculate probabilities and assess likelihoods in games of chance like poker or coin flipping, the stock market operates under a different set of dynamics. In the case of a royal flush, armed with our knowledge of the number of cards of each type in a deck, we can leverage mathematical laws to determine its probability. This is similar to a coin toss, where we know there are two sides and can therefore ascertain the likelihood of each toss with certainty. The challenge with stock prices lies in the absence of the law of pure math. Numerous variables are at play, making relying solely on mathematical principles difficult. However, we can still leverage these variables to our benefit by effectively managing them, thereby increasing our chances of success. We will explore the concept in more detail shortly. Taking the game of poker as an example, the fixed variables are the quantities of cards of each type in the deck. If we were to eliminate all cards from the deck with a value lower than 8, our probability of obtaining a Delta Royal Flush would significantly improve. Similarly, in trading the financial markets, we can employ a similar concept to enhance our chances as traders. By selectively adding or removing certain elements, we can tilt the odds in our favor and improve our overall probability of success. Enhancing your probability as a trader is often described as gaining an edge, and it is essential to comprehend how having an edge can lead to profitability. A prime example of this concept can be observed in casinos. Their business model revolves around establishing a slight advantage in each game they offer and maximizing the frequency of these games. Among them, roulette is one of the most widely recognized games. Let's examine how the casino calculates the edge in roulette before we draw parallels to trading stocks. An American roulette table has 2 green slots, a double zero and a single zero. The numbered slots range from 1 to 36. If you place a winning $1 bet on a number, the casino will pay out $36, resulting in odds of 36 to 1. However, due to the presence of the green zeros, the true odds of selecting the winning number are 38 to 1. That means the casino has a positive expectancy or edge over an extended series of bets, amounting to 5.26%. In practical terms, for every $1,000 wagered, the casino anticipates a profit of $52.60. This demonstrates how the casino leverages its edge to ensure long-term profitability, despite the occasional individual wins by players. Many individuals might reasonably anticipate losing around $5 from the initial $100 if the house's edge of 5.26% were to take effect. However, most people fail to calculate that the edge applies to the total amount wagered rather than solely the starting $100 amount. Let's consider a scenario where you place a $5 bet on each wheel spin. During an hour, the wheel spins 50 times. As a result, the total number wagered per hour would be $250, or $5 per spin multiplied by 50 spins. It's important to note that during these 50 spins, some will result in wins, while others will lead to losses. The outcome of each spin are influenced by chance, and the house edge ensures that on average, the casino retains a portion of the total amount wagered over time. The question at hand is how traders can enhance their probability of success, establish an edge, and execute a sufficient number of trades to allow that edge to generate profits. First, it is crucial to recognize that every trade, like a coin toss or a roulette wheel spin, is inherently random. In the short term, anything can happen, and it is not uncommon to experience both losing and winning streaks. However, with a sufficiently large sample size of trades or bets, the underlying edge or probability advantage will eventually manifest itself. It is crucial not to be overly concerned with the outcome of individual trades or short sequences of events. Instead, focus on the larger sample of transactions conducted over the long term. It is fascinating to note that unexpected and seemingly unlikely outcomes can occur in a game of equal chance like roulette. A notable example occurred in 1943 when red appeared 32 times in a row, setting a record for the longest streak reported in a game of red or black. This extraordinary event serves as a reminder that even in scenarios where the odds are evenly balanced, there is still room for highly improbable occurrences to transpire. Mark Douglas, the author of Trading in the Zone, delves into this concept extensively. He emphasizes that once traders develop a genuine understanding of probabilities and the inherent randomness in any game of chance, the trading journey becomes significantly more manageable. One advantage that traders have over casinos is managing their risk and limiting their loss amounts relative to their potential gains. This is often achieved by implementing a risk-to-reward ratio, such as a ratio of 1 to 2. For instance, if a trader sets a risk-reward ratio of 1 to 2, they are willing to lose $25 when encountering a losing trade. Still, they aim to win $50 when they have a profitable business. When aiming to improve probability and gain an edge in trading, it is essential to consider numerous factors, many of which are encompassed within the framework of trading style. However, the foundation for profitable trading can be traced back to two key concepts: the ratio of wins to losses, or the win rate, and the ratio of the size of winning trades to losing trades, or the risk-reward ratio. Both ratios must work in harmony to achieve a positive expectancy in trading. If a trading strategy exhibits a low win rate and a low risk-reward profile, it will likely result in losses. Similarly, a trader would require an exceptionally high win rate to achieve profitability if the risk-reward ratio is low. Most stocks will likely follow a similar path when the general market trends in a particular direction. If your preferred strategy is to buy pullbacks, you increase your chances of success when those pullbacks occur within a positive overall trend. Similarly, if you prefer trading continuation patterns, it's ideal to do so when the entire market moves in the same direction. This concept is often expressed as "a strong tide lifts all ships," which also applies to stocks. You can incorporate support and resistance lines along with volume analysis to further enhance your trading approach. Doing so improves the probability and consequently increases your win rate. When combined with effective money management techniques, this analysis strengthens the choice expectancy of your overall strategy. Using a price action structure allows you to employ reasoning to limit losses. For instance, if you identify a supporting trend line beneath the price, it would be reasonable to set a stop loss order at a level below it to manage potential losses, especially after the price breaks above a resistance level. Implementing such risk management measures creates an environment of limited risk and unlimited reward potential. While we have yet to delve into the specifics, the underlying theory applies to all trading styles and timeframes. The objective remains consistent: to achieve the highest win rate combined with a favorable risk-reward ratios to gain the best possible trading edge. Thanks for watching. Until next time.